Let us begin with section A. So we have completed 10% and 10% is your syllabus. So let us now start with section A, which is financial statement analysis. In financial statement analysis, we have comparative financial statement analysis. In comparative financial statements analysis, we are going to study the horizontal analysis, the vertical analysis, and financial trend analysis. And there is another topic, that is growth rates, that also we'll cover under comparative financial statement analysis. So financial trend analysis is nothing but it's the horizontal analysis and vertical analysis. Now let us understand what is vertical analysis. Vertical analysis is a method of financial statement analysis in which each line item is listed as a percentage of the base figure within the statement. So this sentence will make a sense when we when we complete an example using the vertical analysis. The another name for vertical analysis is common size financial statements. The vertical analysis can be done for the income statement. It can also be done for the balance sheet. So if the income statement is given and we have to analyze the income statement through vertical analysis, what we are going to do? We are going to take all items on the income statement, revenues, expenses, and income such as operating income and net income, and that will be expressed as a percentage of the net sales for the year. So income statement, what we do, we take the income statement line item and we divide by the net sales and we multiplied by 100. So by this way we can analyze the income statement through vertical analysis. And if we are doing for the balance sheet, what we do, we take all the items of the balance sheet, assets, liabilities, and equity, and we are going to express as a percentage of the total assets. So in the balance sheet, what we do, what we take the balance sheet line item and we are going to divide by the total assets. By this way we can analyze the balance sheet, we can analyze the income statement. So just remember that for the income statement the base amount is net sales, and for the balance sheet the base amount is the base figure is total assets. So let us now understand vertical analysis with the help of an example. Vertical analysis. So let us do the vertical analysis for the income statement and for the balance sheet. For the income statement, what we are going to do, we are going to take the income statement line item that we are going to divide the amount of the base, that is net sales, and multiplied by 100. So the income statement line items are given. We have sales, we have cost of goods sold, we have gross profit, we have salaries, rent and utilities, marketing, other expenses, and total expenses. So sales is set at 100% because every item, every line item, that is cost of goods sold, total expenses, salaries, net income, we are going to divide these all items by the sales. So let us convert year one into percentages. So year one we have cost of goods sold, that is 100,000. 100,000 will be divided by 350,000 into 100. So what we have done, we have taken cost of goods sold as the income statement line item, that is 100,000, and the amount of the base is 350,000, and that we have multiplied by 100 to get a percentage of 29%. So 100,000 by 350,000 into 100 you get 29%, and 250,000 by 350,000 into 100 we get 71%. Like this we can do for salaries, that is 95,000 by 350,000 into 100 we get 27%. 30,000 by 350,000 into 100 we get 9%. 20,000 by 350,000 into 100 we get 6%. 10,000 by 350,000 into 100 we get 3%. And this way we have total expenses. Total expenses we have 155,000. 150,000 by 350,000 into 100 we get 44%. And the net income is 95,000. 95,000 by 350,000 into 100 we get 27%. So we have done for year one, we have converted year one into percentages using vertical analysis. So let us do for year two. For year two, we have the sales is given as 425,000. So the cost of goods sold is 135,000. 135,000 by 425,000 into 100, we are going to get 32%. The gross profit is 290,000. 290,000 by 425,000 is 68%. We have 98,000 by 425,000 into 100, 23%. 35,000 by 425,000, we are going to get 8%. 25,000 by 425,000 into 100, 6%. Like this you can do for other expenses, total expenses, and net income. So by this way we have completed year 2. Let us do for year 3. For year 3 it's the same thing. The line item income statement line item, which is cost of goods sold, will be divided by 500,000 into 100. We get 34%. 330,000 by 500,000 into 100, we get 66%. So this you can do it for salaries, rent and utilities, marketing and other expenses. So total expenses, let us now do is for total expenses. Total expenses, we have 185,000. 185,000 by 500,000 into 100, we get 37%. 145,000 by 500,000 into 100, that is 29%. So what we have done, we have used the vertical analysis and we have converted our income statement into what we call into percentages. Now let us analyze what happened while after converting our income statement using vertical analysis. So in this, what happens, your cost of goods sold has increased, your gross profit has decreased, your salaries expense has decreased, your rent and utilities, marketing and other expenses has remained constant, your total expenses has decreased, and your net income has increased. So in the MCQ and the essay section, the questions can be asked like this. Your net income has increased, your gross profit has decreased. So why your gross profit is decreasing and your net income is increasing? So you can answer that your gross profit is decreasing because your cost of goods sold has increased from 29% in year 1, in 32% in year 2, and 34% in year 3. The gross profit, that's why the gross profit has decreased. Now net income has increased because we were able to control our two expenses. We have salaries expenses, we have controlled our salaries expenses, as well as we have controlled our total expenses. That's why we were able to increase our net income by controlling our two expenses. And you can also mention the percentages that it has decreased from 27% to 20% and 44% to 37%. Now let us do vertical analysis for the income statement. So for vertical analysis for the income statement is already over. So let us now do it for the balance sheet. So balance sheet, we have to take the balance sheet line item and we have to divide by amount of the base, that is total assets, and multiplied by 100. So here in income statement, what we have done, we have taken sales as the base, but here we are going to take, in the balance sheet, we are going to take total assets as the base. So let us convert for year 1 into percentages. So what we do, total current assets, we have 150,000, that will be divided by 300,000 into 100, you get 50%. Then 150,000 by 300,000 into 100, you are going to get 50%. Then total current liabilities will be divided by the total assets. So what we do, we take the balance sheet line item. For example, the balance sheet line item is total current liabilities, it is 75,000, and amount of the base, it's 300,000, that you are going to multiply by 100. So 75,000 by 300,000, it's for the year 1, it's 25%. So by this way you can convert your income statement, not income statement, your balance sheet into the percentages. So you can convert your total current liabilities. We have 125,000 by 300,000 multiplied by 100, you get 39%. Shareholders equity, 100,000 by 300,000 multiplied by 100, 37%. And total liabilities and equity, 300,000 by 300,000, that is 100%. No, it's 33%. So like this you can do for year 2 as well as for year 3. So let us do for year 2. Year 2, what you do, 160 by 335,000 into 100, you get 48%. 175,000 by 335,000, 175, so you get 52%, and 80,000 by 335,000, you get 24%. So likewise you can do for year 3 as well. So 180,000 by 400,000, you get 45%. 220,000 by 400,000, you get 55%. 85,000 by 400,000, you get 21%. 140,000 by 400,000, you are going to get 35%. 175,000 by 400,000, you get 44%, and 400,000 by 400,000, you are going to get 100%. So this is vertical analysis. Now let us move towards the horizontal analysis. Horizontal analysis is a method of financial statements analysis in which we compare historical data such as ratios or line items over a number of accounting periods. The another name for horizontal analysis is trend analysis, common base year analysis. So horizontal analysis, it determines the increase or decrease from one time period to another. In horizontal analysis, a base period is determined in order to perform the analysis. The base period can be the immediate prior period, or it can go further in time. So while doing horizontal analysis, it is the most important is the base period, because every calculation is based on the base period. The increase or decrease can be expressed either you can express the increase or decrease as a percentage or as an amount. It allows analysts to evaluate the entity's performance over time. So if it is in percentage, you have to use this formula, and if it is in amount, you have to use this formula, the dollar and the percentage. The dollar is the current period minus the prior period, and the change is you can remember either the change by original or current period minus prior period, or the base period divided by base period multiplied by 100. So now let us understand horizontal analysis with the help of an example. So this is horizontal analysis. So let us now do it for the income statement. So for income statement, what we do, we take the current period minus the prior period or the base period divided by current period minus previous period or the prior period, or the base period divided by previous period or the base period or the prior period. Year 1 as the base. Here year 1 as the base, we have selected year 1 as the base, and that is multiplied by 100 to get the percentage. So year 1 is the base. Every line item will be divided by the year 1. So the particulars for the income statements are given. We have sales, cost of goods sold, gross profit, salaries, rent and utilities, marketing, other expenses, total expenses, and net income. So let us do for year 2. So year 2, what we'll take, it's the sales. Sales is 425. So here we are finding the horizontal analysis by taking year 1 as the base. So we have the current period is 425,000. The previous period is 350,000 by 350,000 into 100, we'll get a percentage of 21%. So likewise we can do for the cost of goods sold is 135,000 minus 100,000 by 100,000, we are going to get 35%. So for year 2 gross profit, we have 290,000 minus 250,000 by 250,000, you are going to get 16%. For salaries, we have 98,000 minus 95,000 by 95,000, you are going to get 3%. 35,000 minus 30,000 by 30,000, it's 17%. 25,000 minus 20,000 by 20,000, it's 25%. And 12,000 minus 10,000 by 10,000 is 20%. 170,000 minus 150,000 by 150,000 is 10%. So this way you can do it for the year. For net income, it's 120,000 minus 95,000 by 95,000, it's 26%. So we have done it for year 2. So let us do it for year 3. So let us do for year 3. So we have completed for year 2. Now let us do for year 3. So year 3 we have 500,000. So 500,000 minus 350,000 by 350,000. So year 2 data, we are not while calculating year 3, we are not going to take year 2. Now we'll take year 3, that is 500,000 minus 350,000 by 350,000, which is 43%, because we have selected year 1 as base. So every year is going to be divided by the base period. So the current period is year 3. So we have, for the cost of goods sold, we have 170,000 minus 100,000 by 100,000, it's 17%. So this way you can do it for salaries, for gross profit, for rent and utilities, for marketing, other expenses, total expenses, for net income. For net income, what we do, we take 145,000 minus 95,000 by 95,000, you get 53%. So this way what we have done, we have converted our income statement. We have converted our income statement using horizontal analysis in the form of percentages. Now percentages can be graphed, or it can be better understood what the changes had made, the sales, the cost of goods sold, gross profit. So everything can be understood by with the help of a graph. Now let us do horizontal analysis for the balance sheet. So balance sheet also is done same like what we can say, same like the income statement. So balance sheet, we take the current period minus the prior period divided by the previous period divided by the previous period, year 1 as the base, and multiply by 100. So when you want to convert for year 1 into percentage, you take year 1 as the base. Here year 1 is taken as the base. So we are going to convert year 2 and year 3. So for year 2 and year 3, so what we do, when we convert year 2, what do we take? We take the current period, 160,000 minus 150,000 by the base, that is 150,000. You are going to get 7%. And for year 2, it's 175,000 minus 150,000 by 150,000 into 100. You are going to get 17%. We have 335,000 minus 300,000 by 300,000. You are going to get 12%. 80,000 minus 75,000 by 75,000. You are going to get 7%. So you can do it for other line item as well. So let us do for year 3. So we have 180,000 minus, so now year 2 is over. Now 180,000 will be compared with the year 1. So 180,000 minus 150,000 by 150,000, you are going to get 20%. And let us do for total assets. We have 400,000 minus 300,000 by 300,000, you are going to get 33%. And total current liabilities, we have 85,000 minus 75,000 by 75,000, you are going to get 13%. Shareholders equity, let us do for shareholders equity. We have 175,000 minus 100,000 by 100,000 into 100, you are going to get 25%. So what we have done, we have taken this formula and we have converted your balance sheet using vertical analysis in the form of percentages, and year 1 is taken as the base year. So now you can see the graph as well. The total current, what happened to the total current assets, what happened to the total non-current assets, total current liabilities, total non-current liabilities, shareholders equity, total liabilities and equity. Apart from this, we have growth rates. Unlike horizontal analysis, where a single base year is used for all calculations, measuring growth rates using annual dollar amount involves shifting the base year forward by 1 year. The formula remains the same in growth rate. What we do in horizontal analysis, what we have done, we have compared year 2 with year 1. We have compared year 3 with year 1. But in growth rate, it's not this way. In growth rate, what we do, if we need to compare, if we need to find the growth rate for year 2, we have to compare with year 1. And when we need to find the growth rate for year 3, we are going to compare with year 2, not year 1. Horizontal analysis, every year is compared with the base year, but in growth rates, every year is compared with the previous year. Means year 3 will be compared with year 2, year 2 will be compared with year 1. So this is what the difference between horizontal analysis and the growth rate is. So we have here we have completed in comparative financial statement analysis. We have We have studied three topics: horizontal analysis, vertical analysis, and growth rates. Now let us complete this comparative financial statement analysis. We'll click on mark as complete. So overall, what we have completed? We have completed your P2, which is 13% is complete. So let us start on the comparative financial statements MCQs.